Hello everyone, and welcome back to the channel Bitcoin Legacy. Today's video is extremely important for anyone investing in Bitcoin, crypto, gold, or macro markets, because one of Wall Street's most respected voices has made some very bold claims. Billionaire investor Jeffrey Gundlach, the CEO of DoubleLine Capital, has publicly called Bitcoin hype, praised gold, warned about a weak US dollar, and most importantly, predicted no Federal Reserve rate cuts in 2026. These comments came right after the Federal Reserve's January 2026 press conference, during a CNBC interview that immediately caught the attention of global markets. So, in today's video, we'll break everything down in simple terms. Why Gundlach believes Bitcoin is losing its narrative, why he thinks gold is winning, what the Fed is really signaling for 2026, why the US dollar may no longer be a safe haven, and what all of this means for Bitcoin holders and crypto investors. Make sure to watch till the end, because this debate directly challenges the idea of Bitcoin as digital gold. Let's begin. Before we dive into his comments, let's briefly talk about who Jeffrey Gundlach is and why markets listen to him. Jeffrey Gundlach is the founder and CEO of DoubleLine Capital, one of the largest bond investment firms in the world, managing tens of billions of dollars. He is often called the Bond King because of his long history of accurately predicting interest rate cycles, Federal Reserve policy, and macroeconomic trends. Gundlach is not a crypto influencer. He is not chasing headlines. When someone like him speaks, institutional investors pay attention. That's why his comments on Bitcoin and the US dollar matter. During his CNBC interview, Gundlach made a very direct comparison between gold and Bitcoin. He pointed out that over the past 12 months, gold has risen nearly 90%. Bitcoin has declined during the same period. According to Gundlach, this price action tells a clear story. He said markets are moving away from hype and toward tangible assets. In his view, Bitcoin falls into the category of hype, while gold represents something real, physical, and time-tested. This is a direct challenge to Bitcoin's long-standing narrative as digital gold. For years, Bitcoin supporters have argued that Bitcoin is a store of value, a hedge against inflation, a hedge against central bank failure. But Gundlach believes that when fear actually rises, investors still trust gold, not Bitcoin. Gundlach reinforced his argument by quoting legendary investor Jim Grant, who famously said, "The price of gold is the reciprocal of investors' confidence in central banking." In simple terms, this means, when people trust central banks, gold stays weak. When people lose trust, gold rises. According to Gundlach, gold's massive rally shows that confidence in central banks is eroding. Bitcoin was supposed to benefit from that same lack of trust, but in his opinion, Bitcoin hasn't proven itself during real stress periods. Instead, gold has taken the lead once again. This raises an uncomfortable question for crypto investors. If Bitcoin doesn't outperform when trust in governments declines, what exactly is its role? Now let's move to the Federal Reserve side of the story. At the January 2026 Federal Reserve meeting, Chairman Jerome Powell kept interest rates unchanged, holding them in the 3.5% to 3.75% range. But what stood out wasn't the decision itself, it was the lack of guidance. Gundlach summarized the entire press conference with what he called his phrase of the meeting. Powell repeatedly said, "I've got nothing for you on that." No clear timeline, no roadmap, no commitment to future cuts. According to Gundlach, this signals something important. He believes the Federal Reserve is done cutting rates. In fact, he expects no further rate cuts in Powell's remaining 2 meetings. For markets that were hoping for cheaper money, this is a major warning. Bitcoin historically performs best during periods of easy money. When interest rates are low, liquidity increases, risk assets rise, speculation grows. But when rates stay high, capital becomes expensive. Investors turn cautious. Risk assets struggle. If Gundlach is correct and rate cuts are off the table in 2026, Bitcoin may face strong headwinds. This could explain why institutional investors are shifting capital away from crypto and into gold and cash flow assets. One of Gundlach's most surprising statements was about the US dollar. Traditionally, the dollar is considered a safe haven. Whenever markets crash, investors rush into dollars, but Gundlach says this may no longer be true. He explained that during every S&P 500 correction since 2000, the dollar typically rose 8% to 10%. However, during the March to April 2025 market correction, something unusual happened. Instead of rising, the dollar fell 8% to 10%. According to Gundlach, this is a structural shift. He believes growing U.S. debt levels and long-term fiscal problems are causing investors to question the dollar's safety. He has held this weak dollar view for over 2 years and believes the dollar will remain secularly weak, even if the economy slows. Another key point Gundlach highlighted is inflation. Despite aggressive tightening, inflation is still running well above the Fed's 2% target. He pointed out that the 5-year inflation average is around 3.9%. The GDP deflator remains above 3%. To make it easy to understand, Gundlach gave a powerful example. He explained that at 3% inflation, prices rise 56% over 15 years. At 2% inflation, prices rise only 35%. That difference is massive. This persistent inflation makes it extremely difficult for the Fed to cut rates aggressively, and that again puts pressure on Bitcoin and other risk assets. So, what's the big picture here? Jeffrey Gundlach is essentially saying Bitcoin has not proven itself as a crisis hedge. Gold is winning the safe haven battle. The Fed is likely done cutting rates. Inflation is still a major problem. The dollar is structurally weakening. For crypto holders, this creates a serious challenge. If capital continues flowing into gold instead of Bitcoin, the digital gold narrative faces a real test in 2026. That doesn't mean Bitcoin is dead, but it does mean that macro conditions matter more than hype. Jeffrey Gundlach's comments are not an attack on crypto, they are a warning. Markets are entering a phase where liquidity is tight, inflation is sticky, risk tolerance is low. In such an environment, only assets with deep trust survive. Whether Bitcoin can reclaim that trust remains to be seen. One thing is certain, 2026 will be a defining year for Bitcoin's identity. If you found this analysis useful, don't forget to like the video, subscribe to the channel, and share your thoughts in the comments. Do you agree with Gundlach, or do you believe Bitcoin will prove him wrong? Thanks for watching, and I'll see you in the next video.